We have never seen the Fed raise interest rates in a crisis. This has just never happened.
In today's video, ARK CEO, CIO, Cathie Wood, weighs in on inventory pileups, liability-driven investing, commodity prices, and why she believes that the Fed is making a mistake as they base policy on lagging economic indicators. Wood discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation.
The warning flags we have been observing for more than a year now are signals like credit default swaps on banks and many other companies going up the last year. Now, though credit default swaps, for people who don't know, are insurance policies against the bankruptcy of corporations. They're actually bets on the bankruptcies. As they go up, the probability of bankruptcy typically is increasing for some reason or another. And so last spring of 22, I was pointing to credit default swaps going up. What's this about? And then the yield curve inverted in July. The yield curve inversion has always led within 12 to 18 months to a recession. And so I was pointing to that. Commodity prices were falling. The oil price peaked at $130 in March of last year, I believe, and has been nearly cut in half. And I finally wrote a letter to the Fed. I don't know if you saw that, Balaji, but which basically said, wait a minute, you're hiking interest rates 75 basis points at a time and hiking interest rates faster than any other Fed in history, 20-fold within 1 year, it turns out. And here are these conflicting signals, and you're voting unanimously to raise the rates like this. And so I have been much more concerned about deflation. And I think the bank crisis has punctuated that. The two big mistakes that banks have made was assuming that interest rates would stay very low for a long time because the Fed told them that during COVID. And so they invested in long-term government-backed securities, figuring out they'd be money good when they matured. So that was the first mistake. And then the second mistake was to assume that deposits would not leave the system. It wasn't just Silicon Valley Bank. Deposits are leaving the banking system because money market rates are so much more competitive than what people are getting in their bank accounts. So that for the first time since the 1930s, we have a decline in M2 on a year-over-year basis. It started in December. It's intensifying. It looks like it'll be down 3% in March. And I believe this has all the hallmarks of potentially a deflationary bust. We have never seen the Fed raise interest rates in a crisis. This has just never happened, which tells me that they're completely off base. And one of the ways they're off base is they have compartmentalized their responsibilities here. They're basically saying, oh, well, we have tools to deal with financial instability, with liquidity crises and such. But the Fed's primary role right now is to fight inflation. And so I think this compartmentalization confuses the fact that financial instability is going to impact inflation. And the way I think it is going to impact inflation is through a serious decline in the velocity of money. Now, just to give you a sense, in the fourth quarter, these numbers are firm, although they revise all of these economic numbers, and I'm sure we'll be in a recession when they revise it 10 years from now. But anyway, given what we have now, we had in the fourth quarter, we had the year-over-year money supply really had flattened out. It went to zero. It had been as high as 27% in February of 21 and has come all the way down to basically flatten the fourth quarter. But GDP on a year-over-year basis was up 7.3%, which meant that velocity had to absorb that. And it did. It was up 7.1% year over year and 11.4% sequentially at an annual rate. Now, in the first quarter, and I'm sorry if I'm getting too much in the weeds, but this has to do with MV equals PQ. And it's a macroeconomic concept. It's an identity. Okay. So PQ is price times quantity. That's GDP. That's the production of goods and services and the pricing of them. So PQ. And then it has to equal MV. M on a year-over-year basis in the fourth quarter went flat, and it looks like in the first quarter it will be down 2.5%. And it seems to be accelerating to the downside. So what does this mean? The first quarter is pretty much put to bed. So it looks like we know that money is down 2.5% on a year-over-year basis, but down 5.7% at an annual rate in the first quarter, so from the fourth quarter to the first quarter. And this is really before the crisis, which occurred at the second half of March. Now, GDP is up 7.4% on a year-over-year basis. So that means velocity had to accelerate, or the rate of growth in velocity, to 9.9% on a year-over-year basis. And on a sequential basis, it will be roughly the same, 11.6% at an annual rate. But now we get into the second quarter. That velocity, just that trend line going down, it's a powerful force, and it may reassert itself here. So if in the second quarter, money is down 3.5%. Now, M2, 85% of M2 is demand deposits. And the demand deposits we get weekly, and they are continuing to leave the system, some for the money market fund, some for crypto, but they're leaving the banking system. And so that's down 3.5%. And the estimates for GDP, consensus estimates for GDP for the second quarter are roughly 4.5% on a year-over-year basis, which would be minus 2.8% on a year-over-year basis. And the way you could get there is with money going down 3.5% is velocity just staying flat. Now, I think velocity, which when you go through a crisis and the economy seizes up, velocity goes down. When I saw people lined up in front of Silicon Valley Bank, the most technologically savvy people probably in the world, lined up in front of a bank, taking their money out physically, it reminded me of It's a Wonderful Life. I don't know if you've seen that movie, but people waiting in line get their money, and they put some of their money under the mattress saying, I don't know what's going on, but I need to rush to safety. The equivalent was Bitcoin going from 19,000 up almost 50%. There is a flight to safety, but it is also into Treasury mutual funds, which have left the banking system and therefore will not be able to contribute to the production of goods and services in the economy. So 4.5% on a year-over-year basis, minus 2.8% sequentially quarter to quarter, that we have then entered a hard landing. But the risk is what's called a liquidity trap. People holding back even more, not spending anything. Fear, real fear. And hopefully that's not going to happen. But I think this crisis has raised the probability of it. And I do not know why consumers and businesses will migrate back to the banking system, given the very low rates there.